Hello and welcome to Investors Hangout. This fortnightly interaction to help you understand and learn investments and saving issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, at a time when markets are jittery, hybrid funds are much better placed to handle market volatility because they invest in a mix of equity and fixed income funds. The fact that there are 7 different types of hybrid funds, it makes the task to choose which one is best suited for whom a little difficult for investors. So to help us with that and much more, we're joined by our CEO Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Dhirendra, we know that anxious investors choose hybrid funds for the reason that we just discussed. But the fact that there are 7 different types of hybrid funds, how does one go about choosing the best suited one for one's needs?
Yeah, there is a problem of plenty, and despite SEBI trying to classify them and have as little as as few as possible, but we still do end up with 7 of them. But I think investors can actually ignore. I'm just primarily when we are thinking of long-term investor, people who invest for many years, then these hybrid funds have a very strong case. They turn out to be, because it's a combination of equity and debt, they turn out to be relatively more stable, because if it is an all equity thing, if it is an all equity fund, it is a massive blow whenever you see a decline. Rising market, people don't mind anything. People don't look at people don't look at that volatility negatively. But the moment you see a big decline, it will scare you and drive you out of the market forever. So with that in mind, we also keep suggesting that any first-time investor should be starting with a hybrid fund. Now, broadly, when I look at hybrid funds, there are broadly three kinds in terms of asset allocation, and that is something also meant for not necessarily first-time investor, but even for mature investors. Like there are different stages of life when I become conservative. Like when I have still 40 years to earn and save and invest, I can take as much risk as possible. But I have time on my side. But as I get older and I'm about to retire, and then my risk appetite will go down, I will get more upset when I see the same decline. So I should move more assets to fixed income so that it turns out to be relatively more stable. Deriving income. So, broadly from my standpoint, there are broadly 3 kinds of asset allocation. One is dominantly equity, which is 2/3 equity, 1/3 fixed income. That turns out to be relatively more stable than equity, all equity fund. It gets you all the benefits of an equity fund, and it gets you all the long-term benefits. In fact, we have some of the aggressive hybrid fund, 2/3 equity, 1/3 fixed income, which on many occasions for many years, they turn out to be the best performing fund even as compared to an all equity fund, because an all equity fund cannot really move into fixed income. But these funds, because of their constant realignment, because the equity goes down, they invest more in equity goes up, they move money out of equity. So if the market is range bound for a long period, these funds tend to benefit a lot. Then you have a passive investor who wants to just sleep over his investment. He should be 50-50 equity and 50% debt, and we have very few options here. That is why I'll get on to that question later. So this is another thing. You want to keep it equally into equity, equally into debt, and keep realigning. And the fund is a good vehicle because it actually realigns without any tax implication for you. Then you have the very conservative allocation, maybe about 1/3 or maybe a little less than 1/3 into equity and remaining in fixed income. Because most investors also have their need. There are many conservative investors. They just can't withstand the madness of the market. But their need is also to be able to beat the inflation. And if you want to beat inflation, you have no choice but to invest in equity. Now, this turns out to be the finest way of investing in equity, because 20 to 35% money invested in equity will actually reduce your volatility substantially. It will not scare you as much. And if you are holding it for any 5-year period, my hope is that this is the only investment with least volatility be able to beat inflation. Beating inflation is very important, and that cannot be achieved entirely by investing in fixed income. So this is something which should be a very high priority for all conservative and old investor who wants to invest.
You mentioned there are three broad categories. What are the names for those three categories?
Yeah, if you look at these three categories, 2/3 equity, 1/3 fixed income, they are aggressive hybrid funds. Then you have this balanced fund, 50% equity, 50% debt. But right now we don't have too many balanced funds because that category was filled with something else. Right now, the balanced advantage funds are actually filling the gap of 50% equity, 50% debt, because there is most of their mandate is equity ranging between 40 to 60, which means that they are the closest to a balanced fund. And then you have the conservative hybrid funds or the equity income funds, which is 1/3 into equity, 2/3 into fixed income. So these are the three mainstream hybrid funds which investors should actually look at and find the right fund for themselves.
Okay. Now, balanced advantage funds and dynamic asset allocation funds are becoming quite popular among investors these days. Can you please elaborate a bit on them?
Balanced advantage funds got created because of some historic tax arbitrage which was possible. Indian tax laws were very favorable for equity funds. Till a few years back, all your gains from equity was tax free. So till that point, so everybody wanted to have as much fixed income possible in a structure, in a design, but keep the structure as much, but somehow if you are able to make it look like equity, it was treated as equity. And balanced advantage fund actually did end up doing that. These funds used to invest 40% into equity, remaining 20% into arbitrage opportunity, remaining 20-25% into arbitrage opportunity. So the arbitrage opportunities are such that the character of those investment is like that of fixed income. They are almost like your liquid fund. You buy a security of 100 rupees and you sell a security in the futures market for 101 rupee. And the difference of 1 rupee, mispricing which prevails in the market on a day-to-day basis, that creates and generally these are not substantial returns. These are very nominal return, and it turns out to be somewhere in the vicinity of liquid funds. So they would actually make it technically look like a equity fund for taxation purpose, but they were dominantly fixed income. So the tax treatment was able to strike a chord with many investors, that you have a good part of your money in fixed income and all of it is being treated. Now that advantage is gone in a limited way, because now equity is taxable as well. But this category has remained. Now this category is trying to reinvent itself by making a claim that it will try and benefit by changing its allocation in an opportunistic way. That when it is favorable to be investing in equity and when it is unfavorable to be investing in equity, by being in and out of it. And I really don't believe that principle, because I've found that most of the big moves in the market happens when you least expect it. And to be able to benefit from that, look at what happened in the month of March 2020. Everybody was caught off guard, and these are the situations where if nobody has been able to actively time the market well, any fund manager. So that is why I'm not very upbeat on this particular dimension. But these funds actually tend to be 50% equity, 50% into fixed income. That is good enough. That is the reason why there is this dynamic allocation fund which is trying to invest in equity, in fixed income, and these dynamic funds have great flexibility, but most investors should avoid it, simply because they have the potential, they have the flexibility to be 100% into equity or 0% into equity, 100% into fixed income, 0% into fixed income. So despite that flexibility, nobody has been able to use it very effectively. Many of the funds actually have, in this category, they follow a quantitative approach that, if the price to book value is this much, if the price to earning ratio is this much, then we will be in a mechanical way 70% into equity or 80%. So everything will be guided by an algorithm. That also does not work in a very because there could be a stage of the market, and it happens quite often, that markets can be expensive, which means that you will be out of equity. And it can remain expensive and keep going up. So you miss out on the big moves. So that is my problem. My problem is that investors should choose a simple fund with a simple allocation, which follows a which follows a predictable asset allocation, which those three categories do. Rest of them are, trying to do some gymnastics, which does not really work favorably.
So balanced advantage funds are doing that.
Balanced advantage fund are doing that in a limited way. In fact, 2 months back, we did a cover story in Mutual Fund Insight, which was on this, where we were trying to validate that are they really worthwhile? Are they doing a great job? Are they doing a good job? So because it has turned out to be a very big category, it has been able to strike a chord with investors, and investors are putting money into that. And the story is very nice, that we will help you participate in equity and we will protect you from the decline in equity. So this looks like a dream fund. So have they been able to successfully do it? And to our surprise, we realized that most funds don't.
All right. Then there are multi-asset allocation funds which invest in gold along with equity and fixed income. What's your view on them?
My view is that somebody should have gold or at a different level. You should have physical gold or jewelry. I would say that jewelry, but I don't consider gold as an investment. I think of it as a store of value. A store of value which has the longest track record, because even modern financial systems are 100, 150 or 200-year old. Gold has been in existence and in a store of value for thousands of years. So in that sense, it has value, but is it a really inflation beating asset? Is it something, because it's not a productive asset. The damn thing actually sits in your locker, and if you have too much of it, then you just might have to spend money on hiring a guard to protect it, or put it in a bank locker. So I would say that one should have it at a different level, in the locker or in some other form, and or the sovereign gold bonds. If you really have to gift it to somebody at a distant future, they are the finest finest form of gold ownership. And for me, the primary equity class which somebody should be investing, and the financial asset, as a financial asset, is equity and debt. And maybe there is a new category which is emerging, which is real estate investment trust or investment trust. So in that sense, they are emerging. It's still too early days for them. But equity and debt is the right way of looking at it, and one should look at simple product which you can understand, and predictable asset allocation.
What's your view about arbitrage funds?
Oh, I would like to look at arbitrage fund as a liquid fund.
Yeah,
And,
a lot of investors are choosing to invest in them rather than
because the difference between, because if you have if you want to park your short-term surplus in a fund, you have two choices: investing in a liquid fund or investing in an arbitrage fund. The difference between, and if your time horizon is going to be 1 year and little more than 1 year, and if you invest in arbitrage fund, the tax treatment will be 10% tax, because it is treated as equity fund. But the design of it, the character of it, because the arbitrage fund, the way it is run, the way it is managed, the way it is investing, is that it buys a long security. It buys a security, say a share of a company, and buys a company stock and sells the company stock's future whenever there is a arbitrage opportunity, assuming that a month later some future is a contract is available for 101, then the fund sells that and buys the stock at for 100 rupee. 1 rupee is what he will pocket the moment that that contract expires. So in that sense, and the return on these funds are very much in the vicinity of liquid funds only. The tax efficiency or the relative tax advantage compared to a fixed income, where you have to hold it for 3 years, and then after indexation you will have to pay a 20% capital gains tax. Compared to that, this is more convenient. So don't look at it with any other expectation.
All right, time now to move on to our viewers' questions. And the first one has been sent in by Krishna Kumar Tripathi. He asks, can hybrid funds be a better option than debt funds to set up a systematic withdrawal plan? Which category of hybrid fund should he choose?
Systematic withdrawal plan could one might be better off, because if it's a large sum of money and you are withdrawing, your withdrawal rate is about anywhere ranging between 4 to 6% or 7%, then hybrid funds are more important, because fixed income will get you just as much return, maybe sometimes less than inflation, and sometimes matching inflation, because I don't have great expectation from fixed income funds to give you anything substantially more than inflation. So if this is your long-term money, it will depend on my withdrawal expectation. If I'm withdrawing 4% of my capital annually, then put your money in a hybrid fund. And as my sense is that because it will keep appreciating as well faster than the amount of withdrawal, maybe 6%, 7% withdrawal rate will be possible in a year's or 2 years time. Because it will grow faster. So I would say that yes, for systematic withdrawal plan for any conservative investor, he should consider either a hybrid fund and choose the right allocation depending on his because he should look at the right balance. It's very important to actually choose whether you should be in a conservative fund or an aggressive fund or a balanced fund. Because it is entirely a function of your experience. Even a balanced fund or aggressive hybrid fund will show the characters of an equity fund in extreme situations. They are not insulated from risk of the equity market volatility, but they are definitely more stable than an all equity fund. So choose the right one, and most certainly everybody should be investing in hybrid fund for their withdrawal plan or an all equity fund for the withdrawal plan, because fixed income will not fulfill your aspirations.
He also wants your suggestion on which category of hybrid funds should he choose.
Long term, the way to look at it is avoiding the exit load, making sure that assuming that you have whatever amount of money, next 1 year need, you should keep it in a fixed income fund and start your withdrawal 1 year later. So that way all your investment will become long term. And from there, if it is going to be anywhere between 4 to 5% withdrawal will do the needful, choose an aggressive hybrid fund. You want little more, then go for a balanced fund or a balanced advantage. If you want even little more, 6.5, 7, then maybe go for the conservative plan. And why so? Because if you continue with the withdrawal rate and you are in a more volatile asset class, asset allocation, then your withdrawal at a time when the market has taken a hit or taken a beating, you will eat into your capital. So ensuring that you don't eat into your capital, one should actually, so higher the allocation, get more conservative.
All right, now Bhaskar Aglave wants to know if it's fine for a 72-year-old to invest in equity-oriented hybrid funds, or should one shift to conservative or a balanced advantage fund?
For a 72-year-old, for Bhaskar, it depends on two things. If he has invested in equity before, anytime, 2-3 years back, and has been used to the ups and downs, it is rewarding, but he has acclimatized himself with that. That is one. The other is his income requirement. If this is his investment from which he has no return expectation, or he has no income dependence from this investment, then it should be can well be into equity. If he has no experience, he should be into a hybrid fund. If he has absolutely no experience and he needs income from this investment, then he should be in a conservative hybrid fund. If it is going to be a long-term investment, no income requirement, aggressive hybrid fund, likewise. So depends on his experience and income dependence.
All right. 65-year-old Aditya Bhagat has a lump sum of 1 crore rupees to invest for generating regular income to meet his monthly expenses. He wants to generate an income of 60,000 rupees per month. Kindly suggest a suitable investment strategy.
Put simply, 60,000 per month on a capital of 1 crore rupee translates into 7.2% annual return, which is not small and which is not also, very large. I would say that, for your first year requirement, keep it in a ultra short term bond fund. That will get you 5-6%, but that's okay. So you will be left with, something like 92 lakh rupees, 92 lakh, whatever, 7,20,000 rupees gone in a ultra short term bond fund. Rest of the money can be invested for the long term. Maybe, invest in a balanced fund, and after 2-3 years, maybe consider once you are able to build some margin with this withdrawal rate, if you get lucky with the market, then maybe move your money to aggressive hybrid fund. But to begin with, maybe a balanced advantage fund.
The next question has been sent in by Amar. He maintains around 70% of his investment in equity and 30% in fixed income. Now he wants to move 10% of the amount invested in equity to real estate investment trusts. Will it beat Sensex over a horizon of 10 years? He wants to know, and he wants your suggestion on it.
I'm not very hopeful of as of now, because these REITs are They're very aggressively priced. They are, REITs. If you have to understand what it is, these are basically a derivation of the commercial rental yield by investment in those properties. So the way they are priced today, the rental yield is not very high, and I'm hopeful that some appreciation will happen in the course of next 10 years. But at the same time, I'm way too optimistic about the economy, about the companies, about the larger companies, and their ability to. And despite some of the casualties, despite the mortality of companies in the Sensex as well, we have seen that Arcom disappeared from Sensex, Suzlon disappeared from Sensex, or many companies actually die. Despite that, but the ones which actually live, they've turned out to be way too rewarding. So in that sense, I'm very much more optimistic about Sensex than REITs.
All right. Ashok Agnihotri asks, should one invest in a pharma fund right now?
Generally, no. But I'll tell you when you should. Set up your portfolio on Value Research Online. Go to the Analysis tab, and you find that your pharma allocation as a result of multiple funds or multiple stocks that you own, as a result of that is substantially low. It's 1%, 2%, and you want it to be higher. You want it to be 10% of your portfolio. Then invest in a pharma fund. Otherwise, not.
All right. Jumki says she's a risk taker and has been investing for the last 17 years. She now has 35 lakh rupees to invest, which she wouldn't need for another 8 to 10 years. So she's planning to deploy it in 2 flexi caps, 2 mid caps, 2 focused funds, and a NASDAQ fund. What's your opinion on the same?
Yeah, this looks fine, but one should understand that you will have to keep track of these 7 funds, and 35 lakh rupee to be invested in 7 funds, which means 5 lakh rupees each. Reduce it further, and work hard to choose the best of the lot. And I would say that the flexi cap, one flexi cap and one multi cap, one focused fund, reduce it to maybe 20% each. There is a reason why you should have meaningful allocation to one fund. I'm not talking in her context, but if you have very small amount of money in many funds, you are not as interested enough. So the moment you have a meaningful amount of money, you worry about it. You keep an eye on that. You take some action when you think. Otherwise, you just remain complacent about it, or there's an inertia. We don't want to do anything. So you have to, your strategy is fine. Reduce some funds.
Okay. Now, Bhaskar wants to know why are liquid funds not doing well these days? Should he move his short-term money somewhere else?
I don't think moving his money somewhere else will actually generate anything more. Because if you want low risk and predictable return, liquid fund is the way to go. Or maybe ultra short-term bond fund, where you go up little bit on the maturity curve and earn little more. But why they are generating, why they are earning, he's earning less return, simply because interest rates have come down, and maybe in coming days, coming months, there is a fear that inflation is going up. And if inflation goes up, interest rates will go up, and if interest rates do go up, then the yield will come back again.
Marichami earns 30,000 rupees every month and has a 2-year-old son. He currently invests 3,000 rupees a month in PPF and wants to additionally start an SIP for long term to save for his retirement and child's education. What type of mutual fund would you suggest?
When you have a 2-year-old child, and which means that you have many years ahead, at least 15, 16 years ahead for his education. Your own retirement, maybe it's 25, 30 years away. So you have all the time on your side. And go for an all equity fund. Go for an equity fund which invests all over, has a good track record of doing well in a falling market, in a rising market. Maybe go to Value Research Online and hunt for this kind of fund. You will come across, if you are looking at these 2-3 variables, a fund manager who has remained there for all these times, a fund which has done well in a rising market, done well in a falling market, a fund which invests all over, which means a flexi cap fund or a multi cap fund. Choose 1 or 2 of them and invest regularly. And for important that first 1 or 2 years, don't look at the investment value. It's very important because a PPF investor, once you invest in a fixed in an equity fund, and when you compare the performance, sometimes it will be good, sometimes you will feel very happy, sometimes you will be very disappointed. So it really takes 1 or 2, 3 years to for the returns to be visible in a manner where you will not be disappointed, and it gives you enough confidence to carry on
and to acclimatize yourself to the volatility. All right. Akshay Kutumbale asks, if someone starts investing late at the age of 35, how can they make up for the lost time? Also, he would want to retire and get the corpus ready by the time he turns 55.
It's never too late.
Yeah.
Or start when you can, and you still have 20 years. If you plan to retire by at 55 or 60, then you still have many years, 25 years ahead of to invest, and which is good enough time period for equity to fructify. Not only that, for equities to work, it is not that you retire and then you have to turn all your investments into fixed income. You can well retire and it can remain there, and that will start generating if the income from your equity portfolio of a nominal kind is good enough for you to sustain, then even that's a great news. So start now, invest in one or two multi-cap focused or flexi-cap funds, and just be diligent and make sure that you are investing a little more than what you work hard to increase your allocation, because many times investors think that magic will happen. Magic happens over a period of time, but for that magic to happen you should be investing, because if you don't put in the money, what will grow? So what you can make up for the lost time is invest aggressively as much as you can from here on.
All right. Now, Anup has sent in today's last question. He wants to know the difference between a silver ETF and Sensex Nifty index.
Oh, Sensex Nifty index is pretty straightforward. These funds invest exactly in the same ratio, same proportion as the different companies' weight in these indices. A Nifty index, Nifty is a aggregation of 50 companies in a certain weightage. Sensex is a aggregation of 30 companies in a certain weightage, and so these funds get your money, they distribute it equally, and they invest there, and that is why you get the return exactly that of the index minus expenses. Whereas silver ETF, all the money will be invested in silver, and whatever is the appreciation in silver, less expenses will be the return of this fund. So there could be some inefficiency or efficiency while you buy the silver ETF in the market. That can also create a little bit of difference, but basically you are investing in silver as compared to investing in a bunch of companies.
Well, with that, it's a wrap on this episode. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.